Why do the world's most powerful central banks still stockpile gold? We've left the gold standard behind decades ago, yet vaults in New York, London, and beyond hold thousands of tons of it. So if money isn't backed by gold anymore, why do governments still cling to it? Today, we'll unravel why central banks continue to hold gold, what it means for financial stability, and why gold remains the ultimate form of trust in the global economy. Welcome to Unravel, Money and Economics. In this channel, we simplify the world of finance, economics, and money, so you can understand how it all works, no matter your background. Let's break this down into 4 chapters. A brief history of gold and money, why gold still matters to central banks, how gold protects against crises, the future of gold in a digital world. Chapter 1. A brief history of gold and money. For centuries, gold was money. Ancient civilizations used it for trade, and by the 19th and early 20th century, most nations operated on the gold standard. Every unit of currency could be exchanged for a fixed amount of gold. That changed in the 20th century, especially after 1971, when the US ended the dollar's direct link to gold. From then on, global currencies became fiat money, valuable because governments say so, not because they're backed by gold. But even after the gold standard ended, central banks didn't get rid of their gold. In fact, some even bought more. Chapter 2. Why gold still matters to central banks. Central banks hold gold for several reasons: trust and confidence. Gold isn't tied to one country or political system. It's universally recognized and accepted as valuable. Diversification. Most reserves are in currencies like US dollars or euros. Gold acts as a balance, a hedge against those currencies losing value. Liquidity. Gold can be sold relatively easily in global markets, making it a reliable reserve asset. So even though it no longer backs day-to-day money, gold strengthens a country's financial position. Chapter 3. How gold protects against crises. History shows that when crises hit, gold's role becomes crystal clear. During inflationary periods, gold often holds its value better than paper money. During financial crises, investors and governments alike rush to gold as a safe haven. Countries with large gold reserves have extra credibility in global markets. It signals stability and reduces reliance on other nations' currencies. That's why emerging economies like China, India, and Russia have been increasing their gold holdings in recent decades. It's a way to boost independence and reduce exposure to the US dollar. Chapter 4. The future of gold. In a digital world. With the rise of digital currencies and global trade networks, some ask, does gold still matter? For central banks, the answer is still yes. As long as money depends on trust, and as long as currencies can lose value, gold will remain a symbol of stability. It's not about using gold in daily transactions. It's about having an anchor when everything else feels uncertain. So, why do central banks still hold gold? Because even in a world of digital money, it remains the ultimate backup plan, a safeguard against crisis, and a reminder that trust is the foundation of every currency. Have a topic you're curious about? Let us know in the comments, and hit subscribe so you don't miss what's next. As we continue to unravel the world of money and economics, one concept at a time.